Hello everyone. Today we are going to talk about domestic and international dimensions of monetary policy. So, are you all excited to know more about this topic? In this chapter, we have several learning objectives. To identify the key factors that influence the quantity of money that the people desire to hold, to describe how the Federal Reserve's monetary policy actions influence the market interest rates, to evaluate how the expansionary and contractionary monetary policy actions affect the equilibrium real GDP and the price level in the short run, to understand the equation of exchange and its importance in the quantity theory of money and prices. Last but not the least, to explain how the Federal Reserve have implemented the credit policy since 2008. So let's start talking about money. So, if I ask you a question that how much wealth you'll hold as money in cash and currency and coins, and how much wealth you shall hold as other assets like in bonds, stocks, real estate. For that, you have to ask yourself question, what is the relative cost and benefit of holding the money? And what is the relative cost and benefit of holding other assets? In deciding how much money to hold, people make a choice about how to hold their wealth.
Did you know that the Federal Reserve System holds about 1 out of every $5 of the net public debt? The Fed's bond buying effort and their implication for the interest rates are the focus of this chapter. In this chapter, we are going to learn about how the interest rates influence and how much money private individuals and firms desire to hold. That is, what is the demand for money? Let us begin our discussion with the first objective, that is, to identify the key factors that influence the quantity of money that people desire to hold. In the previous chapter, we have discussed how the Federal Reserve's open market operations can increase and decrease the money supply. Basically, we discussed the effect of Fed's action on the banking system. And in this chapter, we are going to learn more on how the Fed's monetary actions have an impact on the broader economy by influencing the interest rates. So for that, we have to understand, we have to discuss the factors that determine how much money people desire to hold. So we need to understand what is the demand for money. You, me, and every one of us is engaged with the flow of transactions. We buy and sell things every day. Because we use money, dollars becomes the medium of exchange. However, all the flows of the non-barter transaction involve the stock of money. Or we can say, to use money, one must hold money. Given that everyone must hold money, we can now talk about the demand to hold it. People do not demand to hold money just to look at the picture of the past leaders. They hold it to be able to use it to buy goods and services. So when we talk about demand for money, it means how much assets individuals wish to hold in the form of money as opposed to illiquid physical assets. We have also discussed in the previous chapters that cash is the most liquid asset compared to, so for example, land, building, rare picture, all those things. So it is sometimes referred as the liquidity preference, how much liquidity preference people want. Money balances is synonymous with money, money stock, money holding. People have certain motivation that cause them to hold money balances. Individuals and firms could try to do without non-interest bearing money balances. Life, though, inconvenient without the supply of money balances. Thus, public has a demand of money which is motivated by several factors. But remember that the demand for money or the quantity of money that the people holds depends on several factors. And what are they? It depends on the price level, interest rates, real GDP, and financial innovation. So why people demand for money? Why they need some dollar amounts? And that motivations can be discussed based on three aspects, that is your transaction demand, precautionary demand, asset demand. What do you mean by transaction demand? Holding money as a medium of exchange to make payments, and it varies with the label related to the nominal GDP. Precautionary demand, holding money to meet unplanned expenditure and emergencies. Asset demand, it means holding money as a store of value instead of holding other assets such as certificate of deposits, corporate bonds, or stocks. Let us discuss more on the transaction demand. So remember, the main reason we keep money with us is to buy goods and services. We want money to buy food. We want money to pay for the gases. We want money for entertainment. All the goods and services are purchased, and for that, we need money. People are paid at a specific interval, once a week, once a month, and likewise, but they wish to make purchase more or less continuously. To free themselves from having to buy goods and services only on the payday, people find it beneficial to hold the money. The benefit they receive is convenience. They willingly forego interest earnings in order to avoid the inconvenience of cashing in the non-money assets such as bonds every time they wish to make a purchase. People hold money to make regular expected expenditures under transaction demand. So just we will not think that okay, let us not hold money, keep it in the bank, will earn interest, or maybe let us keep money in the stock or bonds or in asset. But actually, we need more money, maybe to pay our rent, right? So we want to keep that money, and we forego all the interest that could have been earned if invested somewhere else. As the nominal GDP rises, people will want to hold more because they will be making more transactions. Then the precautionary demand. Transaction demand involves money held to make expected expenditures. You know that you have to pay for food, you know you have to pay for the rent, you know you have to pay for other additional expenses that are required on daily basis. But not only that, but sometimes, there may be some unexpected expenditures specifically to meet for emergencies. So people hold money for precautionary demand, to make unexpected purchases or to meet emergencies. When people hold money for precautionary demand, they incur a cost in the foregone interest earnings that they balance against the benefit of having the cash on hand. Higher the rate of interest, lower the precautionary money balances people wish to hold. The last one is asset demand. Remember that one of the functions of money is to serve as a store of value. People can hold money balances as a store of value, or they can hold bonds or stocks or other interest earning assets. The desire to hold money as a store of value leads to asset demand for money. People choose to hold money rather than other assets for two reasons: its liquidity and the lack of risk. There is also some limitation of holding money balances as an asset. The interest earnings is foregone. Each individual or business decide how much money to hold as an asset by looking at the opportunity cost of holding money. The higher the interest rate, which is the opportunity cost of holding money, the lower is the money balances people will want to hold as assets. Conversely, the lower the interest rate which is offered on alternative assets, the higher the money balances people will want to hold as assets. Here, we are going to discuss about the demand for money curve. Assume that the amount of money demanded for the transaction purposes is proportionate to income. Precautionary and asset demand are determined by the opportunity cost of holding money, that is the interest rate. So, higher the interest rate, lower the money balances people will want to hold as assets. Here, you can see the figure which is showing interest rate on the vertical axis and quantity of money on the horizontal axis. Basically, this figure shows the demand for money curve. If we use the interest rate as a proxy for the opportunity cost of holding money balances, the demand for money curve, that is MD, is downward sloping, similar to other demand curves. If you remember, all the demand curves are downward sloping, right? Let us take an example here. The interest rate movements and the US companies' cash holding. Between 2006 and 2009, annual interest rate that the companies could earn from holding US Treasury securities dropped between 4% to 6% and then to less than 1%. Consistent with the theory of demand for money, cash holding by 500 largest corporations together fell from less than 0.6 trillion to more than 1.2 trillion. Thus, the demand for money curve of US businesses slopes downward.
Thank you for listening to the lecture relating to the learning objective 1. If you have any questions relating to this learning objective, feel free to contact me via Zoom or on Canvas discussion board. I'll be happy to answer your queries. Apart from this, you can also post your question on the Google Doc that I shared with you. Thank you very much.